Have you ever set a stop loss, watched the price hit it by a few ticks, then reverse without you? It feels personal, but the truth is more mechanical. Behind every chart is an unfeeling engine, a market-making machine bound by risk constraints, not by lines on your screen. This engine doesn't care about your analysis. It must balance its books, and your stop-loss orders are the fuel it burns to stay neutral. Today, we strip down this engine, exposing the order book illusion, gamma-driven feedback loops, and academic evidence that dismantles retail trading myths. Welcome to DeepQuant, where we turn noise into signal with mechanisms and data. Most retail traders imagine the market as a tug-of-war. More buyers push price up, more sellers push it down. That picture is dangerously incomplete. In mature markets, your directional order accounts for under 2% of price impact. The rest comes from entities indifferent to charts, market makers hedging options, pension funds rebalancing, index trackers, and high-frequency arbitrage. When volume surges, it's rarely a breakout, it's the passive machinery aligning books before the close. You're not battling traders, you're feeding a data engine that runs on ledger balances, not hope or fear. SEC market monitoring data reveals a staggering fact. In U.S. stock order books, only about 3% of displayed quotes ever result in a trade. For liquid ETFs like SPY and QQQ, the fill rate drops below 1%. That means 97 to 99 of every 100 quotes are phantom orders, placed to influence perception, then cancelled milliseconds before execution. The order book is a stage set, not a supply-demand reflection. If you rely on level 2 depth as a gauge of pressure, you're reading a script written by the machines you're trading against. When a market maker sells you a call, they acquire a short position with positive delta. They don't want directional risk, they want the spread. So they immediately buy shares equal to the options delta times contracts times lot size. If the stock rises, delta increases, forcing more buying. If it falls, they sell to reduce exposure. This mechanical rebalancing, repeated thousands of times a day, drives price moves unrelated to chart patterns. The market maker isn't trading against you, it's balancing its ledger according to a mathematical constraint that overrides any view of fair value. Gamma is the second-order risk that turns small moves into a forced stampede. As the stock nears the strike of sold options, gamma surges. Each dollar price increase now requires disproportionately more shares to be bought. This buying pushes price higher, activating deeper out-of-the-money options and triggering further hedging. It's a self-feeding loop, price up delta up by more price up further. This isn't speculative demand, it's a mathematical obligation. The GameStop squeeze was not retail buying power alone, it was a gamma squeeze forcing market makers to buy millions of shares, igniting a short seller inferno. GameStop is often told as a David versus Goliath tale of retail crushing hedge funds. But the deeper driver was the delta gamma engine. Retail poured into near-dated call options, market makers, short those calls, held massive short gamma. Each uptick forced them to buy more stock to stay delta neutral. Their own buying pushed the price higher, lifting more options in the money and amplifying the feedback. Hedge funds betting on a decline were crushed not solely by retail buying, but by Wall Street's automated risk machinery. It was a gamma squeeze, amplified by the very infrastructure designed for stability. Academia hasn't been kind to technical analysis. One comprehensive study tested over 7,800 indicators across multiple assets, executing simple buy, sell signals and accounting for costs. The result, not a single indicator produced a net profit after friction. 0. Those that occasionally showed promise, like volatility indices, didn't give directional signals, they merely described the current regime. This delivers a brutal message: backtest profitability reflects the historical regime, not indicator merit. When the regime shifts, the same line becomes a knife that cuts your account. Here's why your stop-loss triggers at the worst moment. Retail traders, educated in the same methods, place stops at nearly identical levels, just below a swing low or under a round number. This clustering creates dense pockets of sell-side liquidity. The market maker's algorithm treats these as guaranteed liquidity, not panic. When adverse price action forces selling to rebalance delta, its algo sell orders probe these levels. Once triggered, the flood of stop-loss orders fuels the decline. The machine uses this liquidity to complete hedging, and when forced selling dries up, price snaps back. Your stop wasn't hit by chance, it was consumed as fuel for necessary rebalancing. The market maker operates under a hard constraint: the total delta of its options book must be neutralized by stock inventory. If the market rises and delta increases, the market maker must buy shares, even as the stock gets expensive. If the market falls and delta decreases, he must sell into weakness. This appears as buying high and selling low, but it's not a strategy, it's a risk control rule that keeps the firm alive. The ledger doesn't care about price levels, it only cares about delta neutrality. This obligation creates price moves unrelated to fundamentals and explains why markets extend far beyond chart patterns. At the heart of the retail struggle is a fundamental mismatch. You operate on a flat, visual map of history, while your counterparty navigates a three-dimensional space of risk constraints. The lines you draw have no legal force, they compel no one to trade. In contrast, the market maker's ledger is a binding contract with its risk model. When delta reaches a threshold, the algorithm fires, regardless of charts. To stop being fuel, shift from reading patterns to understanding the engine. Where are the forced buyers and sellers? What options expire? What hedging flows are due? Only by aligning with these mechanical necessities can you move from victim to operator. These lessons dismantle old beliefs. The market isn't a chart to be read, it's an engine to be understood. Your stop-loss isn't hunted out of malice but out of mathematical necessity. By shifting focus from lines to ledger constraints, you can stop providing fuel and start reading the machine's next move. Risk management is no longer a fixed price level, it's the ability to sense whether you're standing in a quiet oscillation or in the path of a single-flow turbine. When you grasp the order book illusion, the gamma feedbacks, and the delta hedging algorithm, your trades transform from directional bets into calculated engagements with market infrastructure. If this dissection of the market engine gave you a new lens, you're on the path from reactive victim to informed operator. At DeepQuant, we break down financial mechanisms into data, models, and risk conditions, never mysticism. Remember, first risk control, then returns. See you in the next analysis. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.